Welcome back to Your Finance TV, everyone. The end of your work week. Maybe you're watching this over the weekend, but it's the end of the quarter, it's the end of the month, it's the end of the half year. So who better than to have to go back and review the markets than Jay Pelosky with his musings? How are you, Jay?
I'm great, Scott, but here at TPW, buddy, we focus forward. We don't talk about going back. We want to focus forward.
Well, I do love how you focus forward, but it looks like you're trying to keep us in the dark there at the moment.
Yes, some slight technical difficulties on the lighting. Sorry you can't see as profile this, handsome face, but I'm sure you and the audience will deal with it.
I'm sure we will. Before we jump into the show, don't forget to click on the like and subscribe button we got right below. Just about past 3,000 subscribers. So thank you, everyone, for your support so far. All right, let's get into the title of your monthly musings, whichever way we want to look at this, because they're very different to the way you usually do it. But it's called The Great In-Between. Now, usually I've got a little bit of a line. Maybe it is the great in-between is something in between my eyes that people don't ever focus on. But what is, when you're referring to the great in-between, what is that?
Well, first of all, Scott, this is the monthly, right at the end of the month. You know our process. And for new viewers, and sounds like there's new viewers coming every day, new subscribers, which is fantastic. But at TPW Advisory, we write our we write our musings every Friday, typically 1,200 words or so. Then at the end of every month, we do our monthly. It's a deep dive. And then we update our model portfolios at the beginning of every new month. So that's going to be next week's business. So here we are at the end of the month, end of the quarters, So this is a monthly. And, it's a heavy lift, right? The monthly, we cover, we're global macro, we're multi-asset, we're thematic. So we cover the whole gamut. And the monthly this month ended up being about 5,700 words with 31 charts and tables from over 20 different independent research sources. And so what we do is we boil it down into an executive summary. As you know, Scott, that's what you have in front of you. And that's about 1,100 words today. And so the great in-between actually references all these transitions that I think we're going through, both in the economies and in the markets. But it really goes back to when our kids were younger, our boys were younger, we used to spend the weekends up in the country in Northwest Connecticut. And so we would drive from Manhattan up to the country. And so we would talk about the Hudson River and the West Side Highway. And then we'd be out of the city and we'd talk about the great in-between, which is basically all the space in between the end of the city and where we ended up with our place. And so it just struck me that this is the environment we're in now, the great in-between, works off of our musings last week, which we titled Transitions. So we really took those transitions. Remember, we wrote about rotation over a month ago. We wrote about the birth of the new was the title of last month's monthly. So the birth of the new, rotation, transitions, the great in-between. And so here we are ready to talk about those transitions if you so desire, my friend.
Always, because you have been focused on these transitions. And I think you had a little bit of a spot there yesterday on Bloomberg for a small chance to talk about it. But fortunately, in the environment that we're in here, we can actually go a little bit more in depth. And I believe, and don't be mad at me if I get this wrong, but I think there's 5 of them. Can you walk us through them?
Oh, that's great. I love you. You're a quick study, man. You get right on it. It's awesome. And yes, we were on Bloomberg yesterday, and Bloomberg's great because I just finished putting this all together for the most part. And it takes a couple of days, as you can imagine, 5,700 words, 30 plus charts and tables. And then you have to boil it down into, that TV soundbite, right? Where typically you get 3 minutes. So you take this huge document, all this thinking, boil it down into a couple of sound bites, and then that actually serves great because that was the origin of the executive summary. So we're all about, process at TPW Advisory, big believers that if you're going to do global macro, you have to have a process. And so we were able to use that TV hit, But now, as you say, what's great about Your Finance TV is that we get a chance to really walk through and talk about the sound bites. You only get, 10 words in a Bloomberg or CNBC interview. So the 5 transitions really are, the first one is from rate hikes to rate cuts, right? We think the Fed is done. We think we're at the end of a rate tightening cycle, one of the most aggressive in the last 40 years. And we're beginning, and arguably already have begun, a rate cutting cycle in the emerging economies. And so we highlight that the PBOC of China has already started to cut rates. And we note that we expect next quarter, the Q3, that some of the Latin American central banks will start to cut rates. And we think Brazil will probably be among the first. For those who haven't really followed Brazil, it has real rates of 10%, even though its inflation rate is below that of Germany. And so we make a point that that inflation is really a developed market issue, not an emerging market issue. And we've got a great chart in the monthly highlighting exactly that. If you take out Argentina and Turkey and a couple other emerging markets, EM inflation is running at about 2%. So we think that's going to be the rate cutting cycle that really sustains the second half of the year. So that's transition one, from rate hikes to rate cuts. And then the second transition is from a focus on monetary policy to fiscal policy. And that obviously makes sense because we're no longer in that rate hiking environment. And fiscal policy, we think, is really going to be the story of the next couple of years. And the FT had a great piece, and they called it the global industrial arms race. Namely, what we've been talking about is the CapEx boom to deal with our 3 C's of COVID, climate, and conflict. And you've heard this for months and months and months, even years, Scott. We've been talking about the 3 C's, but now you have Bidenomics in the US, you have the Fit for 55 and the Green Industrial New Deal in Europe, and we expect in July's Politburo meeting in China, we expect China to come out with some stimulus, fiscal stimulus, but directed more towards stimulating domestic demand and not the traditional China stimulus of fixed asset investment. But this is the big theme, and this is what folks have not yet understood, because we haven't had industrial policy, or what's being called the new industrial policy, in the United States for 70 years, not since the 50s. And so no one in the markets, no economist, no strategist, no analyst has experienced an environment where public spending is a major factor in driving the economy on an ongoing basis. And that's what we have with the Infrastructure Act, the IRA, the CHIPS Act. All this stuff is starting to manifest, and that's going to be one of the big drivers to the US and global economy in the years ahead. So that's going to be our focus going forward. And then the third is from, and follows naturally, is from recession to recovery, right? So everyone's been waiting for the recession, talking about the recession. We have never been in that camp, as you know, again, talking about our middle path between high inflation and recession, which we first introduced a year ago in the summer of 2022. So we have never been believers in the recession call in the US. And our view is that we're in an early cycle global economic recovery, again, led by Asia, right? Japan is growing well above potential. Fastest growing G7 economy in the world is Japan, believe it or not. China is growing 5% per annum. Everyone bashes China like there's like a piñata, right? Every hour you get a story on how China's not meeting this and China's not doing that. The reality is that China is growing more than double the pace of the US and Europe. And the rest of Asia is as well. Southeast Asia, India, all are growing at roughly 5%. So the US and Europe are coming behind the global recovery that's already underway in China. We call that a desynchronized global economy, and we expect it to kind of resynchronize in 2024, 2025, when the US and Europe, go more fully into their recovery and join Asia. So that's the third. And then the fourth, again, fitting very nicely together, is from equity bear market fears to early bull market rotation. And as we talked about a few minutes ago, we wrote about rotation. We titled one of our musings, to make it as clear as possible. It was the title, it was one word, and it was rotation. And what have we had happen over the last month? Home builders have broken out. They're up 12% over the last month. Transports have broken out. They're up about 10% over the last month. Transports have broken out versus utilities. So, that's not recessionary stock market behavior. That's a stock market that's sniffing out an economic recovery and is buying cyclicals to position for that recovery. And we have been always big believers in letting Mr. Market tell us what's going on and not us try to tell the market. And that's been one of the main reasons why 30 years in this business, we're still here, still able to kind of have a perspective on markets, is because in large part, we follow the markets. We follow price. We're not technicians, but we understand when you see home builders breaking out and transports breaking out, that most likely you're not going into recession. So that's the fourth. And then the fifth and final rotation is from the US to the rest of the world. Again, something we've been talking about for quite some time, but here we talk about it in the context of the US dollar weakening and emerging market FX strengthening. And so one of our big fixed income positions for the last, for all of this year to date, has been in emerging market local currency debt. And lo and behold, it's massively outperforming our benchmark fixed income, which is Barclays Ag. EMLC is the ticker. Folks can take a look at it. And that's what we expect to see continue as the Fed goes on hold, the dollar weakens, and rest of the world equities and commodities tend to do well. And that's what we expect to see. It's already unfolded to some extent, right? Again, as you know, we've been talking for a year or more together on these Fridays, which is great. We talked about Europe last year. Europe has been a big monster outperformer. Beginning of this year, we talked about Asia with a focus on Japan. Japan was up local currency terms almost 20% this quarter. And now more recently, we've been talking about emerging markets with a focus on Mexico and Brazil, as well as on China. China has not yet worked. It's hard to get everything right for sure. China has not yet worked. We think it will. And we think the stimulus and the Politburo meeting will help that. In Latin America, amazing story. Many people will find this very surprising. The Latin American ETF, ILF, has actually outperformed the Qs this quarter. So everybody talks about, how narrow a market we've been in and 7 stocks and big tech. Latin American equities people have outperformed technology this quarter. So those are the big 5 transitions. And, it's a product, obviously, of a lot of work, but they all fit together, at least the way we look at the world. And we think that's the focus that we're going to really kind of narrow in on and zero in on, is the language we use, zero in on these transitions as we go through the second half of this year and into 2024.
Well, thanks for that breakdown, Jay. You deserve a drink. Like that was a lot to go through pretty quickly. But I'm going to throw you straight back into the fire. How do you position yourself for these then?
Again, it's one of the things that we think we have an edge on here at TPW Advisory is our ability to synthesize large amounts of data and then kind of bring it down to some digestible sound bites or action items or portfolio positions, right? So remember that we have our two model portfolios here at TPW Advisory and our model portfolio delivery service. The first is our global multi-asset or GMA, roughly 25 to 30 ETFs that cover the entire world, all assets. So it's benchmarked to ACWI, Barclays Ag, and the Goldman Sachs Commodity Index. And then the second is our TPW 20, which is 100% thematic, really focused on fast evolving new technologies, climate, demographics, infrastructure, big themes like that. So how do we position for the transition is by employing barbell strategies. That's really been our focus this year, is to have barbells. Again, we've referenced it in prior conversations on YourFinanceTV, but here we break it down again into 5 again. Wow, I didn't even count that in my prep for this. So yes, 5 barbells. Global equity barbell is barbelling U.S. equities on one end, non-U.S. on the other. We tilt towards the non-U.S., so we're overweight non-U.S. with a focus on EFA, so Japan and Europe. We're very, very bullish on Japan. Japan is growing above potential. Japan is exiting decades of deflation. Japan wants inflation, so they can exit the 30 years of deflation. That successful exit, has led the Nikkei index in Japan to reach 30-year highs, not 3 months or 3 years, 30-year highs, nominal highs. Japan has negative real rates, deeply negative real rates. I mean, here's an example of how deep. Inflation is running at about 3.5% to 4% in Japan. 10-year JGBs yield 40 basis points. 40 basis points with 4% inflation. So very negative real yields. The currency is at 20-year lows. That's a very, very constructive environment for equities. And we believe that in the next couple of months, in the next quarter, certainly by the end of the year, the Bank of Japan is going to move off yield curve control, allow interest rates to go up. That's going to create a bear market in JGBs, and money is going to flow from fixed income to equities in a massive domestic investor asset allocation shift. So we're very bullish on Japan. And then the rest of the non-US is obviously in the emerging markets that we spoke of. So that's the first. The second is a equity barbell within the U.S. equity position. So this is within our U.S. equity position. We barbell with big tech and cyclicals. As we talked about before, Mr. Market is telling us very clearly, no recession. As home builders and transports break out, we have a great chart on the home builders in the monthly. And then the third is the switching gears from equity to fixed income is our fixed income barbell, which is U.S. high yield on the one side and emerging market local currency debt on the other. We talked about EMLC earlier. We have virtually no sovereign developed market sovereign debt on our fixed income allocation. And so that's a massive underweight, which has worked out great. Barclays Ag is basically flat for the year. iGov, the international sovereign, mostly DM, also not really done anything year to date. And as I pointed out earlier, high yield and EMLC are both up about 5% or more on a total return basis. So that barbell has worked out really well. And then the fourth is a cross asset barbell. Okay, so here we kind of put together digital. So our AI focus, which, as you know, we're believers that AI is kicking off an innovation, a new innovation cycle for the United States and the world. So digital on the one end of the barbell, physical on the other. So physical being commodities, right? And that's the other part of the models that haven't really worked yet. The two things that haven't worked in the first half of the year are China equity, and commodities. And we're slightly overweight commodities, and so that's been a drag on our overall performance. But we're big believers that as we move from recession to rotation, or recession to early cycle recovery, as we move from bear market to early cycle bull market, that commodities could be the big surprise in the second half of the year. And when we talk about commodities, we're focused primarily on the industrial metals as well as energy. We also have a position in gold miners, which we think is going to continue to do fine as the central banks allow for slightly higher inflation as we move forward. Think 3% instead of 2%. So then the last is our thematic barbell, and this really pertains to our TPW 20. We have future tech on one side, and then climate on the other. So future tech is things like fintech, genomics, cyber, things of that nature. And then on the climate side, it ranges from carbon to EVs to nuclear to solar and wind to renewables, pretty much the whole gamut. And so that's our barbell within our thematic model portfolio. And the thing that's interesting there, and we touched on it several weeks ago when we wrote about patience, again, one word title for amusing, patience, was that the charts on some of this future tech and climate stuff look really pretty interesting because they had huge spikes, right, in 2020, 2021, then a tremendous collapse, just up and back. And then they've been basically going sideways for, in some cases, a year, in some cases, 18 months. And at the same time, they have obviously survived as companies, the companies making up the ETFs, have survived through the very challenging macroeconomic backdrop. And so our thinking is that as we move into that global economic recovery that we think is really going to manifest in the second half of this year, more fully in 2024, 25, and 26, that the future tech and climate stuff is really got potential to have a significant catch-up period. And so we're already seeing it start to manifest in a few. ARC Genomics, which is in that model, ARC FinTech, which is also in that model, the TPW 20. Both of them are up 40% year to date, but are still back to where they were in 2018 in the case of ARC FinTech. So very interesting to watch there. So we end up saying stay patient, stay invested, and then BTFD. Don't want to say those words out loud because one of them is not a good word, but I think everybody knows what we mean, right?
Fire truck, right? Fire truck.
You don't pass.
All right. Well, listen, that's a great breakdown now. But one of the things of the monthly musing, which I really do enjoy, is to go through the 5 breakdowns on that as well. 5 seems to be the number for this show.
Yeah,
climate, economics, policy, politics, markets. And a lot of people do tune into these to break those down. So with that in mind, obviously we've spent a lot of time going through this and it's a great breakdown. Let's see if we can run through these with a bit of speed. So let's start with climate.
Yeah, let's do that. And I agree with you. Climate is here because we think climate is the single biggest global macro theme of the decade, not of the month of the year, the decade. And here we write mostly about solar and how solar power is really playing a big role in the heat waves, particularly in Texas. We talk about the job creation that's going to come through the IRA and renewables in the United States. Estimates range to about roughly 4 million new jobs in wind and solar between now and 2030 in the United States. We then talk about solar in Europe and note that for the first time ever, solar power is now generating more, solar production now generating more power in Europe than coal. Coal has always been a main source of power, coal-fired generation, and now solar power is overcome that. And then third, we touch on China, given that China really is dominant in virtually all of the clean energy spaces, whether it's solar or EVs or batteries. And we really draw the parallel between China having invested heavily in this space, top-down, government-controlled investment, has really forced, in a way, Europe and the US to mirror that a little bit with the new industrial policy to guide the public sector, the private sector, to spend the money necessary to mitigate climate. And so that's what we talked about earlier in this new global industrial arms race to deal with the issues of climate. So climate continues to be something we focus on, something we invest in, and something we think is going to really be critical to understand as we go through the course of this decade.
Right, and let's move on to economics then as well. I'll let you get another drink just because I've had you talking on this episode.
Get a little dry in the throat. Economics, we think the question is really simple. Will manufacturing catch up to services, or will services catch down to manufacturing, right? Because service PMIs are well above 50 in expansion pretty much around the world. Manufacturing is below 50, again, pretty much around the world. So which way those two relationships play out will drive this global economy. And our bet is that manufacturing will catch up, namely because the inventory destocking, which took place over the course of last year, is now going to be met with inventory restocking as we go forward. And also as disinflation boosts real incomes, and that in turn stimulates consumption. So real income growth in the US right now, for example, is running at about 2.5% per annum. We have another really solid chart in the monthly showing the same in Europe as well. So as inflation falls, real incomes go up. That supports more consumption, which drives more inventory restocking. And that plus this new industrial arms race are the things that we think are going to drive the global economy.
Okay. One I always like to talk about is policy, seeing as though there's a lot of definitely differing views on this one still.
Politics, then policy, my friend.
Oh, you want politics first? So, well, there's always differing views in politics.
The idea is that economics plus politics lead to policy, and policy drives markets.
Okay, so let's dig into politics.
Again, there's a rationale here at TPW Advisory with our process, okay? So yes, let's talk politics. First of all, we say we don't have any edge in the great Russia coup guessing game, so we're not going to play there. We do talk about the U.S. presidential campaign, and we note that President Biden is really going out and pushing Bidenomics, really driving that. And we note, and we have, again, some great charts in the monthly showing that President Biden has generated more jobs, or more jobs have been generated under President Biden than any other recent president. And secondly, that the misery index, right, that combination of unemployment and inflation that President Reagan made so powerful when he was running against Jimmy Carter, the misery index under President Biden is the lowest it's been since pre-Reagan days. So a lot to run on for President Biden, and that was really the focus of our politics this month.
Okay, then now we can get to policy.
And policy we've covered kind of extensively in the early section. The Fed is done, and even if it's not done, if they raise 25 next month, we don't think it really matters at all. It's already priced into fixed income. We don't see that as leading to the tech sector taking a big tumble or having cyclicals reverse. So we think the Fed is effectively done. We're really paying attention to the BOJ for that ending of yield curve control. We think, again, that's going to have significant implications for Japanese domestic asset allocation. We talked about our shift in focus from monetary to fiscal policy, right? The industrial arms race. And then we touched on Bidenomics and China's upcoming Politburo meeting and our expectation that there'll be more support there. Again, some really good China charts in the monthly as well.
Okay, and that all wraps up beautifully into markets then. So where does this all mean? What does it all mean for markets?
Well, we talked about our barbells, right, at some length at the top. So we're not going to repeat that, but we will, very simply, let's talk about the top, where we are asset allocation wise. So importantly, in our global multi-asset, we are overweight equities. We are deeply underweight fixed income, deeply underweight. So to give you a sense of what deeply means, our benchmark is 40. We probably have roughly 15 to 20%. So more than 50% underweight our benchmark. And then slightly overweight commodities. And importantly, fully invested. So remember, in the first part of this year, everybody was talking about cash is a great place to be. We want to be in cash. Cash can yield 4%, 5%. Well, guess what? In the first half of the year, cash has been one of the worst performers, one of the worst places to put your money, right? Equities, global equities are up 12, 14%. Some markets up even more. Fixed income, as we talked about, high yield, emerging market debt, up 5-7% total return first half of the year. Commodities have been down, so that's not been great, but cash has really not been anywhere near the kind of performer people were talking about over the last couple of months. And our mantra continues to be that the Fed on hold equals US dollar weakness, which equals rest of the world and commodity outperformance. We really think the second half of the year could be good for commodities. We see, even as over the last couple of days, what looks like some positioning for Q3, particularly in copper. We have a position in copper miners as a play on the EV space, and really seeing what looks to be some positioning there. And so that's really the bulk of it, right? We want to stay invested. We want to be patient. We want to be rotating into cyclicals. We want to have good exposure to non-US markets. We want to lean into some of that commodity weakness on the oil front, on the industrial metals front, and take advantage of what we see as an opportunity as the world starts to pick up and global growth accelerates as we go through 2023 and into 2024. And importantly, last thing we'll say is that, we've been in this game a long time, as you have, Scott, not quite as long, but decent amount, not quite a pup anymore. We know that when the summer vacation, which we're now full swing summer season, July 4th weekend, that when the analyst community comes back, they start to focus on the out year, right? So really the shift now starts to be 2024. We joked at the beginning that we want to focus forward at TPW Advisory. And we do that because we believe markets are forward-looking discounting mechanisms. So if you want to beat the market, you have to be forward-looking like the market. And forward-looking now at the end of June into July is not looking forward to going to the beach and having a pina colada. It's looking forward into what does 2024 really look like? Because that's what the market is starting to sniff out.
Well, I'm looking forward to next week's show as well, Jay. So it's as always, and I'm sure the viewers are too. Jay, thank you so much for your time today. You enjoy your weekend and happy July 4th.
Yes, happy July 4th to you. Even as an Aussie, I'm sure you'll celebrate. But happy July 4th to all the viewers, and hopefully everyone has a safe holiday weekend with friends and family.
For everyone else out there, good luck investing.